Welcome to The Investing Show, where we discuss ideas to help you make more of your money. I'm Simon Lambert of This Is Money, and joining me today, I've got Tom Becket, Co-Chief Investment Officer of Canaccord Wealth. Tom, welcome to the show.
Thank you for having me.
It's the start of a new season of The Investing Show. We're coming back to quiet times. We've got inflation down, Federal Reserve finally cutting interest rates, couple of wars going on, UK elections just happened, US election coming up, which promises to be volatile. And while stock markets are riding high, investors are very concerned about the Magnificent Seven driving them and valuations. We're going to get on in a minute to how you set up investors' portfolios to deal with all of that, Tom. But first, as a Chief Investment Officer, what does your job entail? What does a Chief Investment Officer do?
Well, when you said start of the season, I hope we've been talking about football. That would be a lot easier, even as a Watford fan, where things always end up being pretty average, to be perfectly honest. But you're rightly pointing out that as an investor, there's an awful lot to deal with. I mean, particularly at the moment. I would say it's always like that, to be honest. Just the problems move on and the subjects change. Being an investor is never particularly easy. And that's really translated into the job of being a Chief Investment Officer. When we do internship programs or people come for work experience, I have to point out to them that the job never stops because you can never know everything. But my job really is to translate the events of the world, combine them with asset market valuations and an investor's time horizon, and try and create a sensible asset allocation to meet people's long-term financial aims and aspirations. It sounds perhaps simpler than it actually is, but in very simple terms, it's that. How can we take the range of opportunities and the risks in front of us and translate that into sensible risk-adjusted returns?
And when you talk about those assets, the main assets being shares and bonds, but other assets as well?
Yeah, possibly. But I mean, I think you need to think about who your target audience, and it's probably very similar to the viewers of this show, mostly retail clients. And so when we think about the range of investment opportunities out there, I try and keep things simple. The world is complicated enough. Financial markets are complicated enough. And I don't think there's really any historical evidence to suggest that taking additional complexity adds much value to a portfolio. So when I talk about investments, it's really stocks and shares, bonds or fixed interest, and elements of alternatives. But I try and these things very simple. These are all the sorts of things that your viewers can invest in through their various different platforms or their own wealth managers.
And when they're thinking about their own wealth, the other thing to be thinking about presumably as well would be cash, the cash savings that they hold.
Yeah, 100%. And cash is once again a relevant investment asset class. It wasn't for much of the last decade. So yes, we're thinking about a holistic pool of clients' assets. And quite often we do manage all of a client's assets or a big chunk of their assets. So we absolutely have to incorporate views on all of that at once.
So getting on to the more complicated bit, after you made that sound very simple, how do you set up a portfolio for a world like it is at the moment? What are you thinking about when you're making those decisions and deciding what to invest in?
It's a real balance because on the one hand, as you rightly pointed out already, there's a lot of risks out there. But at the same time, if things seem risky, that typically leads to there being opportunities at the same time. Now, the way that I've always built portfolios is to make sure that you don't have all your eggs in one basket. It sounds corny, but ultimately, diversification has been proven through the years to be a benefit to a client portfolio. Everyone says you've got a long-term time horizon, you should just own equities. That's a view. I think at the moment you could probably make similar returns from fixed interest as you can from equities. So what we're trying to do is balance those range of asset classes in a portfolio to create the sorts of returns that mean people can carry on spending in the future like they are today with hopefully a little bit more. So typically, our standard portfolios would normally have roughly 50% in equities and 50% in other. I think that's a sensible way to start an asset allocation framework.
And when we talk about investors, we talk about them as being cautious, balanced, adventurous.
There is no standard terminology behind that either.
Yeah.
They're just terms that are banded around, mean absolutely nothing, but yes.
What do different people need to think about when they think about what kind of investor am I?
Look, I think you just have to think about how much money do you want to make and what is your long-term time horizon. And ultimately, I believe the best arbiter for investment success is inflation. If you can generate a return in and above inflation, and hopefully a little bit more than inflation, then that will be sufficient to making sure you can carry on spending in the future like you are now. And that should be your ultimate guide to investment success. To me, it's irrelevant if an index is down 20% and you're down 18%. That helps absolutely nobody. So it's all about the concept of generating real returns, inflation plus returns. That is absolutely the starting point for everything we do. And I would suggest that be the starting point for everyone thinking about investing for the future.
And where does the balance lie now, in terms of your thinking, when you look at the world that we're in and the months ahead, the couple of years ahead, in terms of that protection versus profit debate?
Well, of course, what we've learned during the turbulent 20s is that sometimes what you expect to happen doesn't actually happen. So if you think back to 2022, which, to borrow from our late Queen, was an annus horribilis for investors, that was the year when diversification failed. What your asset manager and wealth manager would tell you was that normally when equities performed poorly and fell, bond prices would go up, and they'd offset that risk. The whole concept of the balanced portfolio concept, and it completely failed. So I think what we're learning through this decade is you need to think about things differently. Yes, think about the correlation between different asset classes, but also you have to think about them each on their own merits as well. And I think what you're learning right now is that you do need to think differently about the way that you invest, particularly in a decade now, which is so very different to that last decade that we invested in what we call the easy tens. During the 2010s, it was broadly very easy to make money from investment portfolios and asset markets. It was an era when central banks kept interest rates broadly at zero, and you had a great deal of economic predictability and a great deal of predictability over inflation. It was also a simpler world. I mean, the geopolitical problems we have now seem very, very stark by comparison to back then. I mean, it wasn't a very easy period then either, but this decade is much more turbulent. We know that. So again, I think you just need to think about things differently in this decade by comparison to the last decade. And I think that by thinking differently, there are a range of investment opportunities that we can get into.
Were you surprised by how fast central banks put up interest rates and how high they put them up?
No, because I think they were just so far behind the curve. If you think about it, at the around Easter time, at least at the end of the first quarter of 2022, Jay Powell, who chairs the Federal Reserve of the US, which is the world's most important central bank, was still pretending that inflation was transitory and that interest rates probably wouldn't need to go up very much at all. He was wrong. If you consider a 25 basis point move in interest rate, which is standard to be one hike, there were 22 hikes that followed going forward. And they had to, because they had to get back hold of the inflation situation which they themselves had contributed towards. It struck me as being slightly ironic at the time that we let the arsonists put out their own fire, but forget that for 1 second. That is now history. So they had to put up inflation to try and quell the inflationary problems. And let's be honest about it. And I've been very critical previously on the show with you before and for other mediums of communication about the actions of central banks. I don't necessarily think they've done a bad job here. Interest rates went up, inflation started to come down, and now we're seeing interest rate cuts on the other side as the inflation data plays ball, and that allows central banks to cut interest rates. Of course, the medium-term prognosis, particularly in this turbulent decade, is more difficult to judge. But for the moment, I think their actions have proven to be sensible. But the reason they went up so far, and the fastest rate in 40 years, was because they just were so late in putting them up. They had to act more aggressively.
And do you think that's going to be in rate setters' minds as they start to come down? And is there going to be an element where they're going to think, okay, well, the silver lining to this cloud is that we've actually got rates back to a level that's relatively normal, and we're in no rush to get them back to super, super low levels again, whatever the markets think?
There's an awful lot to unpack in that question, but yes. I mean, I think the fact that they now have ammo in the gun and they can shoot off interest rate cuts to support an economy which is likely to slow will be seen to be a good thing. And I think that they will cut interest rates pretty aggressively, despite some protestations that they won't, because there's a lot more going on here than just inflation and economic activity. So let's break it down into simple building blocks. So from an economic perspective, all things being equal, the global economy is currently going at a slower rate than it has done for the last few years, which is no surprise because the post-COVID experience was very strong for the economy because of pent-up demand. So the economy is starting to slow. There's a few complications within that. The US is probably slowing a bit more than perhaps previously expected, although the data is somewhat ambiguous, but let's assume the US is slowing. Europe and the UK remain pretty stagnant, pretty anemic with regards to overall growth rates. But at the same time, China has now started to demonstrate a willingness to grease the economic cogs and try and get the economy moving forward. So I think you put all that together, and that suggests an economic growth rate which is slower than it has been for the last few years, but a global recession, which, let's be honest, are really quite rare, is avoided. Inflation now looks like it is a battle that has been won, at least in the short term. What we're seeing is disinflationary tendencies throughout the global economy. Disinflationary means that prices are still going up, but not at quite as fast a pace as they were beforehand, which is not hard because the inflation rates at certain places were 10% year over year a few years ago. Thank God we're not living through that period again now. That was particularly painful for financial markets and us, of course, as citizens and consumers. So inflation is coming down. There's some caveats to that. I mean, obviously, the situation we're seeing in the Middle East, were that to get even more out of control, would be a problem. The Iranians closed the Strait of Hormuz. This isn't a prediction, but if that was to take place and oil supplies were to be impacted, that could create some inflationary uncertainty. Likewise, if this big port strike on the east coast of the US continues a very long time, that could add to inflationary pressures. So there's a few caveats around the inflation situation that we have to deal with in the short term. But again, I think inflation probably comes down. That means interest rates are going to be cut. And a lot of your viewers will be wondering, well, where might they get to? They might have a mortgage to refinance with. Please don't come back to me if I'm totally wrong on this. But, my expectation would be that interest rates in the UK probably gets in this cycle down to around 3%, similar to what they'll be in the US, I would argue as well. Predicting that cycle is challenging enough. Predicting out longer term is more difficult because I say there's more things at play here. When the inflation situation is considered, we all must remember that in 80% of previous inflationary environments, there's been a second wave of inflation. And I think that's the one thing which could really upset markets here because people have now become very complacent about the prospects of inflation shrinking. And it might carry on, so it might play ball. My suspicions are by this time next year, we could start to see a bit of an uptick in inflation. Whether or not it's a big problem is a different question. I think the way to look at it is if 2% was the ceiling on global inflation in the last decade, 2% will be the floor this decade. I think that's the way to look at it. But inflationary problems might well come home. Now, when it comes to central banks and governments, I think they want some inflation because the debt piles we've accumulated and accelerated through the COVID experience are problematic without any inflation. If we had some deflation, that would make those debt piles even a bigger problem. So I think they will err on the side of inflation. This is a political choice more than anything else. But those debt piles I just referred to need to be refinanced. With interest rates at high levels, that makes it much more difficult for governments to refinance their debt. Don't forget, it's you, me, and your viewers who pay for this debt because governments haven't got any money. They take our money to do these things, but that's often lost on our politicians. But that strikes me as being a situation where interest rates probably can't go up too far in the future. So again, there's an awful lot going on here, but I think the medium-term path is for inflation to play ball with some longer-term caveats, interest rates to come down to roughly 3%, and for central banks to err on the side of inflation rather than deflation, which probably means they are more aggressive with interest rate policy than previously might have been expected.
The value of compounding over long periods of time. There's a lot of investments that can do well for short periods, but then they collapse or there's a big down cycle or something goes wrong with them. Whereas those investments that can continue steadily growing their profits and dividends year after year and compound that are incredibly valuable. Lots of people talk about it, but not a huge number of people actually practice it. The patience of hanging on to long-term compounding in earnings and dividends. So the value of compounding would be a big lesson.
Where do you see the opportunities at the moment, kind of based potentially on that outlook, but also based on what you're seeing in the markets?
Well, I think this is where there's some good news. And I probably wouldn't have been allowed on a show like this 3 years ago because we were in a situation where the outlook for asset markets was quite poor. I mean, we still thought there were opportunities to make money and build portfolios, but the outlook was difficult because we were living, with the benefit of hindsight, through a classic asset market bubble. And let's just go back to the end of 2021 because I think it's important for your viewers to think about it in the context of where we are now, and that will set, hopefully, some confidence in the ability to make money from markets going forward. So at the end of 2021, not only did you have extremely expensive equity market valuations, you also had a great deal of investor complacency. And also when it came to things like fixed interest markets, because of the original situation back then that we talked about with interest rates broadly being at zero, fixed interest returns through yields were the lowest they'd ever been before in history. Let's not forget, at the end of 2021, there were $18 trillion worth of bonds around the world that had a negative yield. Now, that might sound like an arcane or complicated term for some of your viewers to get their heads around, but that means you are paying the person you're lending money to look after your money for you. And everyone says, we didn't invest in that. That would just be ridiculous. But there were $18 trillion worth of bonds that did that. So someone was investing in there. But even if you wanted to go invest in a government bond, your best expected return was zero. Before fees, before inflation, before platform costs, whatever it was. And I'm not just making it up. The yield was zero. Simple as that. So your best expected return was that. So the outlook was pretty poor. If you want to invest in a higher quality but still safe bond, you might get 1.5% for investing in a UK high quality corporate bond. And taking risk through things like emerging market bonds, you might have got something like 4%. Okay, so that was where we were at the end of 2021. The reason I'm more optimistic now, and have been really since September 2022, is just because the whole return prospects have improved markedly. So in equity markets, levels might be similar to where we were at the end of 2021, but valuations have come down because global corporate profits in the last few years have been good. So there are some pockets of extremes, I would suggest, in areas of the US equity market. Perhaps some of those companies included within the Magnificent Seven has been talked about on many shows before, and it's become terminology that everyone understands. Those big US technology companies, I'd point out their share prices might have been magnificent, but their business models have certainly been magnificent, and they probably they've generated so much profitability they deserve the success that they've had. But outside of that, it's really hard to sit here and say there's massive enthusiasm towards UK equities or European equities or your emerging market equities. Imagine 10 years ago, come on a show like this, everyone talks about emerging market equities. Now you come on, people consider their swear words. You can't mention them. So I think there's enough apathy and distrust in parts of the equity markets you'll make good returns. And in fixed interest markets, you've gone from a situation where your government bond yield was 0 to now it's 4. Where investment grade corporate bonds yielded you 1.5, now it's 5.5. The higher risk corporate bonds and higher risk emerging market bonds yielded you 3, 4 back then. It's now more like 7 or 8. So I think really viewers should take comfort in the fact the only future guide to investment success is buying attractive investments at sensible valuations and holding them for a long time. The starting point for doing that now, despite the politicians and central banks' best efforts, is much better than it's been for quite a long time. And it's nowhere near as attractive as it was in 2022. Let's be honest about it. We've moved on quite a long way in the last couple of years. Everyone's portfolios have recovered quite a great deal. But do I think we can make normally sorts of returns going forward from here? Yes, I do.
And if we've got that scenario where we've got bond yields back to a level where bond yields probably should be,
yep.
And that means there's an opportunity to find some bonds that people don't like. You can buy them and you might make some money. We've got shares that aren't priced for perfection, that are not particularly loved. There are some, obviously the Magnificent Seven shares, many of those are priced for perfection, and they may disappoint, and that may cause investors troubles, but it means there's lots of opportunities elsewhere. Where do you see the pitfalls that investors could fall into?
Yeah, there are many. And I think over-optimism and complacency are probably the two things to watch against. And again, some of these things depend on your time horizon. I mean, those Magnificent Seven companies might not perform very well for the next couple of years because their valuations are excessive. Do I think you won't make money on a 10-year view? Undoubtedly. I think some of these companies are fantastic companies. It's just the short-term entry point might be considered to be too expensive. So I think over-optimism is probably the biggest pitfall here. I said earlier, I think the greatest complacency that markets might have is around the fact that central bankers have got this. And I've already said I think that the recent experience has been good. I think they've done a good job for the last couple of years. Maybe even the Bank of England. Maybe not. But central banks broadly have done quite a good job. Some complacency around inflation and inflation coming back in, I think would be a problem because that's what we saw in 2022. And no one is expecting that now. And I think that's where the biggest pitfall comes from. One of the obvious things that people would point towards is perhaps the political and the geopolitical situations that we're in. And that's all part of the turbulent 20s framework that we've talked about. The reason we've got these problems, in no small part, is down to the fact that we've got such a great societal divide. The efforts of the central banks in the 2010s was to enrich the wealthy in society, and they believed that we'd see an economic theory called the trickle-down effect, which, like most other economic theories, proved to be total nonsense, where basically you made the rich wealthier, they spent money, and that went down through society and benefited everyone. It didn't. It just made the rich very, very wealthy and created this distorted financial society that we're living in. So because of that distorted financial society we're living in, we are seeing more extreme outcomes in politics, and I think feeding through into geopolitics. And yes, that will continue. Whether or not that's a pitfall for investors on a structural basis, I think is is arguable, but probably not. It just means we're going to have a much more volatile backdrop. So I think those two pitfalls mostly are around expectations being too extremely positive and there being complacency. And again, I would suggest there'll be positive returns, but would guard against having too great an expectation for returns. And I think, again, around that sort of concept of inflation and that coming back into the system and causing a problem for extended asset prices.
Okay, Tom, that's all we've got time for. Thank you very much.
Thank you very much.
Thank you for watching The Investing Show. Join us next time. Goodbye.